Hey YouTube, this is Zach with Achilles Financial, and today I want to talk to you about credit spreads. In particular, I'm going to be utilizing Draftkings as my credit spread candidate of choice. Because I'm familiar with the company, it's one that I watch on a regular basis, if not daily, and because I think that it's going to show some very nice premiums that we can utilize to grow our income. Or if you're not interested in making the credit spread on Draftkings, at least you'll be able to see how I utilize it. The reason why I'm utilizing Thinkorswim, the web version, is because it can very coherently showcase the potential profit and loss on the platform. So we're going to dive right in. Throughout the video, if you find this content helpful, please leave a like or subscribe. So first and foremost, as you can see, we've got Draftkings. They're currently trading at $66.59, which is actually down right at 4.5% on the day. The reason why I highlight this is because when we look at their chart after hours, they're down with the broader market. Now the question is the market going to continue going down or go up? If I knew the answer to that, then what I would be able to do is make a lot more money. What we're looking at right here on the credit spread side is, what is a credit spread? It's when you buy a farther out of the money option and then you sell a nearer to the money option. What that gives you the capability to do is someone will pay you for those two contracts, which means you walk away with cash. The way that you're able to buy one and sell one is you will have to hold the difference between those two contracts in collateral. I like Draftkings because for the most part, I know how they trade, I know the range they trade, and when we see this kind of downwards slope over 3 days, it sets up the premiums quite nicely for a stock that has been trading in a relatively close time period going forward. So for Draftkings, the two options that I am going to look at are going to be the May 21st. I'm looking at the put side because I'm bullish, the $60, and the May 1st, 21st put for the $55. Now in Thinkorswim, I have the capability to buy and sell button right here. It's very similar functionality. I know a lot of you utilize Robinhood as well. Again, you have to make sure that you are selling the nearer to the money option. So again, we're at $66, and the option price that I want to sell is the $60 one. As you can see, I now have my bid and my ask price over here on the left-hand side or right-hand side of your screen, and I can move up and down within there. So I can move kind of back and forth and kind of get an understanding of where I would accept this price. So for this example, I will utilize the midpoint of that bid and the ask. So right now, what this would require from me is I would be required to have $500 in collateral, assuming you don't have a margin trading account, sitting in my cash balance or my buying power. That $500 would then be held up as collateral for this approach. So what that would look like is, you can see that again, I would have a buying power effect of, I would have a remainder $349 associated with the current balance that we currently have. The reason why I highlight that is because again, you have to have the $500. You don't have to have $350, which would be the difference of the 500 plus this 152. Now, as we walk through this approach, or as we kind of place this on here, I do want to highlight that what this would do is give us the capability to earn $152 in cash. So you can see that balance right here, where as long as the stock price stays over $60 on that day, you will keep all $152. Now, it's a pretty sharp decline where you go from here to, I'll just go down to 59. This is one of the reasons why I like Thinkorswim, is because it has the profitability. If it dropped down to about $59 a share, I would actually only have $50 of profit. Now, where the danger comes in is if it does drop below that $55 point, I am at max risk and I would lose $348, which is more than my initial investment reception of $152, because what this is doing is it is taking that full $500. Now, the good news here is that you can buy this back at any point in time. Generally speaking, I don't buy back my credit spreads unless they're definitely in the quote-unquote danger zone. Now, the good news here is that when I go through this trade and it says this cost $150.70 credit, that is going to show up directly into my cash balance, my buying power. So the minute I hit send here and someone purchases this option, I will receive $150 in cash. In the Thinkorswim platform, you'll see that I have buying power over here of $76 and cash of $76 in this particular instance. If you are utilizing this type of functionality, what would actually happen is if you had that cash balance buying power of $576, your buying power would be that $76 plus the $150 cash, and your cash balance would still be $576, but it would still have the difference between those two numbers available because you would have to have at least $500 in cash available here. The reason why I like utilizing credit spreads is because this can be a consistent way to generate income over the course of a calendar year. Again, right now this price is set for 60 days out. However, I'm utilizing $500 that I am essentially putting up to get $150 back. So I'm looking at right at or north of a 30% return over the course of 2 weeks, or 2 months rather. That's 58 days. If you are consistently able to generate those type of returns at 30%, the gains add up very, very quickly. Now, granted, I don't think that the premiums are always going to be this quote unquote juiced, but the stock is on a 3-day decline and it's down 4.5% today. So the downward pressure is growing, which gives me the capability to get $152 of premium. Generally speaking, when I go through this process, I like to ensure that 2 wins here, so 2 times where you don't lose money, would still be profitable if I lost once. So in this case, this trade does not meet my criteria. That being said, if we were to bump this up where it would be worrisome, where hey, it's the $60 and the $50, or the $60 and the $65, now I would make $215 versus $285. That being said, we're still in the worry zone because we're still closing in on that $65 point where I could be losing money. So I always like the safer option, but I still like the idea of the potential 30% premium. Keep in mind that options are very risky, and I'm not a financial advisor, I'm just some guy on YouTube. That being said, when I'm looking at options, I always make sure to keep in mind why is an option priced the way that it is. And generally speaking, it's due to inherent volatility in the stock, as well as the momentum. So again, this one's going down, so the put premiums are going to be higher. On the inverse of that, the other thing we need to look at is time. So this option has 58 days. If I did this exact same option for 30 days of April 23rd, you can see my premium is now only $179 compared to the $215 that we were just looking at. However, again, can be a great way to generate income throughout the year, especially if you have a lot of cash balance on hand. Just keep in mind that there is risk associated with it, because if it does go down farther past your break point or strike prices, then you are going to lose the full collateral. Right now I've done $500, but just to further highlight this, I can go all the way down to $50, which would be $100 or $1,500 in collateral. And you can see there that I have increased my risk, where at this point in time I have a maximum risk of $1,180, and instead I now have $320 in profit. If I personally feel comfortable putting this much money up, yes, I'm willing to sacrifice some of this sloping risk right here, but what I would rather prefer to do is, instead of 65 to 50, I prefer to just do the 65 to 60 and just do 3 and 3. So yes, I'm putting up the same amount of collateral, but my potential here is I do have that $963 loss. However, I could also have a $537 gain, which is still north of that 30% number I mentioned earlier. So this is just some of the ways that you can utilize credit spreads to help grow your income in a portfolio, especially if you are particularly cash heavy. Now, this Draftkings one is particularly aggressive. However, if you said, hey, I don't necessarily want to be that aggressive with my portfolio, you can go all the way down here and use 50 for the closer one, and you can use 45, so still $500. However, you'd only be getting 29 right here. We'll just say 30 to make it easy, which would only give you $90 in the instance of 3 contracts I have here, where you're still putting up that same $1,500. However, theoretically, it's going to be safer. Keep all this in mind just because there's a lot that moves with credit spread, so I would definitely recommend, if you are new to this, operate utilizing the paper trading functionality that TD Ameritrade has. You can see here in the paper money that you can go in and you can make trades and changes and kind of mess around in the platform at no risk. You can see how the options prices move. So if you find this content helpful, please leave a like and subscribe. And if you think that this is something that you'd like to talk more about, feel free to join the Discord in the description below, where I talk about my plays and some of the strategies associated with this. I have been hesitant to go in on credit spreads lately because it's been such a volatile market. However, that doesn't mean there's still not a lot of capability here on both the call side and the put side. So let me know in the comments below your thoughts, and if you find this content helpful, let me know. Thanks. Talk to you later.